Welcome to Chapter 12. Okay, there are two announcements before I start with a little introduction on this chapter. First is, please log into Blackboard every couple days and always read through the announcements since the last time you were in there. The second one is, I hope you are all clicking on the weekly modules, clicking inside of them, and reading what's in there. A lot of times I'm telling you parts of the chapter that you can skip for reading and other important material. So don't just go on My Accounting Lab and just say, okay, I see this assignment is due. Make sure you're checking those modules. All right, so welcome to Chapter 12. In our prior chapter, we looked at long-term operating assets. And we learned about depreciation and amortization of intangibles. Well, there's a special situation that occurs, and it's called an impairment. Okay, so I have the definition up here. I highly encourage you to take notes on this in my future videos. And so basically the impairment occurs when the asset's total future cash generating ability falls below its carrying value. Okay, so what does this mean, cash generating ability? Well, what are we going to get out of that asset in the future? Okay, and if you remember, like when those operating assets are booked, they come in at historical cost if it's a purchase, right? And then if we're depreciating or amortizing it, the carrying value is slowly going away. For some intangibles, we do not amortize. And so that carrying value is the same as the acquisition cost, right? So what if you have an asset that's just not going to produce what you hoped to when you got it, or it's damaged, or there's a new regulation that prohibits the way that it's being used? There might be reasons, and we'll get into some of those. We don't want to have it on the books for a carrying value that exceeds what it's really worth to us. This goes back to our conceptual framework with what the asset's definition is, and that is it has probable future economic benefits. And we want to make sure that the information provided on the balance sheet is both relevant and it represents faithfully the underlying value of that asset. So an impairment is a way that we have to go through it, and we have three categories of assets that we look at. Each one of these has different rules. Okay, so the first one is property, plant, and equipment that gets depreciated, and any finite life intangibles, the ones that are amortized. So with this one, the book value, the carrying value, is slowly getting lower over the life of the asset. This second group is the indefinite life intangibles. They are not being amortized. And so we have a different test for dealing with them. And goodwill is so special that it gets its own category. All right, so that's all there is to this video. And we're going to go through each of these categories over the next 3 videos.